Hi, and welcome to Access to Justice. I'm your host, Heather Malarick of Merrick Law. I'm joined by my co-host today, Evan Clark of Kahane Law. Hi, Evan. How are you doing?
Hi, Heather. Great as always. How are you?
I'm well. Yeah, hanging in there. We're joined today by a very special guest, Kim McDonald of McDonald Advisory. Kim is a financial advisor and insurance advisor with Raymond James. Hi, Kim. How are you doing?
Hi, Heather. Hi, Evan. Thanks again for having me on the program today. Excited to have another financial person on the show because now it's even Stevens, lawyers and financial people. So I always like these episodes.
Me too. I learn a lot. From them. So I'm looking forward to our chat today. Access to Justice is a Canadian podcast with a mission to educate Canadians about the law. We interview experts in law, mental health, and finance, focusing on the topics that create the greatest barriers of entry into the justice system. You can find us on YouTube on our A2J podcast channel and online at a2jpodcast.com. So without further ado, I would like to welcome today's guest, Vince Gervais. Hi, Vince.
Hey, Heather.
How are you doing today?
Not too bad. Just September is always a busy time of year for us. We have the summer lull, and then even this year on August 30th was sort of the end of the last weekend. The phone just started ringing off the hook. So we are busy, but it's always good to take some time away to inform. Looking forward to the questions, variety of questions that will come.
Great. Well, we're so excited to have you and really appreciate that you take time out of your busy schedule. It's back to school time right now, too, as we film this. So there's always a sort of a transition at this time of year that everybody's getting used to. So Vince, I just have a quick introduction. I've kind of peeled this from your bio. You're a principal at Frost Valuations in Edmonton, Alberta. I understand you have a Bachelor of Commerce degree, and you're also a chartered business valuator. Vince has been valuing businesses in Alberta and Saskatchewan since 2008. And outside of work, I understand you're an avid cyclist, an aficionado of classic literature, Francophile, which I took from our conversation earlier this week. You're a big fan of Paris, and you are the proud and new owner of a Costa Rican coffee farm that prides itself on equal trade. So anything else you want to share or correct in that bio?
I changed our traded cycling for running, so we run all the time. Okay. We even do full family runs now. So the baby, who is just over 1 now, goes in the stroller, so he's not a very good runner. But the 8-year-old to 12-year-old, they all run with me. And we do, no kidding. And we do between 5 and 8K each week. There's a 5, a 6, and an 8K that we do. So that's the only change. The equal trade coffee thing, we could talk about that probably forever. It's something that I sort of devised with the locals in Costa Rica when I bought a farm off of a family there. And then I started spending a bit of time out there, sort of getting the lay of the land. And we started talking about middlemen and where all the money for the coffee goes. And we found out we sold direct from them, from Costa Rica to Edmonton or Canada, what have you, they could make a lot more money. Just an idea of how much the coffee farmer actually makes down in Costa Rica. They make less than 10% of the value of the bag, and the actual cost add is about 20%. So there's a sort of a missing 70% for the Costa Rican farmer. And the way we worked out our equal trade thing was they get about 50% of the total sale price, so they're up about 400%, or call it 500%. But yeah, that's it's not necessarily what we're here for today, but it's a really interesting venture.
I mean, I was looking at coffee farms the other day. What made you buy one in Costa Rica?
Well, the other thing I traded cycling for was cigars. and I absolutely love cigars. So I had the idea that I would make my own cigars, and so I thought I'd get into growing tobacco. And I know quite a few people in the Caribbean, a few down in Central America. And I said, well, where should I buy one? I'm thinking Nicaragua. And they said, well, if you want to lose all your money or maybe pay a lot of bribes and so on, then Nicaragua is a good choice for you. I thought, okay, so bad idea. So it was kind of nice. I got in with a guy named Philip Wynn. He's an owner of a cigar company. I just texted him on LinkedIn. I said, hey, what's the deal with growing tobacco in Costa Rica? He said, don't do it. And I said, oh, he's just trying to get rid of the competition, so I'm going to try and do it anyway. So I spent 2 weeks looking around and came to the conclusion that he's being pretty honest and that it was really a bad idea to buy a tobacco farm, but I still wanted to do a farm. And the coffee farm that we got is in Costa Rica. And Costa Rica is really a lot like Canada, more paperwork, even like when you go to certain countries, you can get the sense that things are loose. They're not loose at all. But they're not mean about it either, but their paperwork is second to none. I need to get a bank account. I needed to submit 5 years of my bank statements just to get a bank account. So a very, very administratively strong company, and a standard of living. It's not a massive poverty standard of living. It's just a really nice place. And they have some of the best coffee growing regions in the world. And that's where our farm is. It's in this place called Cope, which is in Dota, which is in Terrazú, which is in San Jose, which is so on and so forth. So the addresses are about 50 characters long, no more like 150. That's crazy, our address. But so safe, to answer your question, well administered and high quality was how we got into Costa Rica.
You ever thought about growing some cocoa there as well while you're at it? Get some chocolate out of there?
That's not a bad idea. And the thing with coffee is that you need to, so you'll have your coffee trees and they'll be, dispersed throughout. Then you need shade trees. Mm-hmm. And so you don't really want a single crop thing. So if you look at like a Starbucks farm, and our farm's not far from the Starbucks main farm in there, is they have like these rows, these really ugly rows. You see that orange soil under it that sort of runs like that. That's a bad coffee farm because for a few reasons. They're just sucking all the nutrients out of the soil and there's not much to go back into it. Whereas ours looks like a jungle with trees in it. So you have all sorts of things. You got banana trees, you got grasses, you got shrubs, you got all sorts of things. And for land like that, what happens is you have vegetation dying and re-nutritionizing the soil. That's not a word, but
that's the term. That's the the technical term.
And then but it also provides shade. So your plants last longer. Plants have a life of about 20 years. So your plants last a lot longer if you have shade on it. And you can put basically anything you want. And cocoa could be one. What we have right now is avocado trees. So we've got, I feel like the ultimate hipster having an avocado / coffee farm, but that's what we have.
Nice. Yeah. So it sounds like you're into, I think they call it permaculture, right? Of just farming in a sustainable way that can be self-sustaining as opposed to, the old industrial model of leaching everything out of the soil and erosion and et cetera, et cetera.
It's very profitable too, especially for the employees who they live on the farm. Mm-hmm. So they could spend their wages going to get food, or I can say, just eat whatever you want. And so they do. The avocado trees are pretty bare, but they're pretty well fed. So it's awesome.
So how much is that farm worth?
Ooh, numbers.
Oh, you haven't done a valuation?
Oh no, I've probably done it about 30 times every second day. How much are we doing? How's the production rate going?
I want to know how do we get our hands on the coffee?
Oh, you can go to, we're literally sold out right now. We just brought in a small batch first, but it's a DOTA coffeecompany.com. And you'll see my ugly face on the website all over. We go through all the equal trade stuff we just talked about, or you can Instagram at us at Dota Coffee Company, or Facebook Dota Coffee Company as well. We hired a social media guy recently, and his style is different than ours. Like You'll see if you check it out. But ours is more natural. His is more stock. Let's call it that.
Well, that's pretty awesome. That's one of my life goals, is to be in a situation where I can buy a farm that practices whatever it's farming in a sustainable, environmentally sustainable way. Because I feel like it's just a better way to do things. I don't know. There's something about that really appeals to me. I don't really know why or how to explain it, but.
Well, I think you're right. I think you're right that it's a better way to do it. And the big thing with it is the startup cost is lower. I don't really know when non-permaculture or less natural farming is better. Maybe it's when you get to the really high end, but in those mountains, you can't really get machines out there. Like, you are literally on the side of a mountain. It's not a euphemism or anything. It is the side of a mountain. So maybe when you're using really heavy fertilizer and heavy pesticides, that's why all that stuff goes away. But if you don't want to do that, I don't know how Starbucks even has it's not free trade. What's that? When the organic certification, having lived at their farms, I'm not really sure how that makes any sense. I guess they're Starbucks, so they can be maybe rather.
They'll decide. Maybe they made their own organic. What's the word for it? Their own designation. Yeah, they made their own. We're Starbucks organic.
Right. Yeah.
Anyways, we don't want to get sued by Starbucks. I'm sure everything's great in the Starbucks coffee farms.
I was
Not the
gonna
certification.
I was about to go off on a capitalist rant about how whether or not environmental degradation is included in the valuation of corporations. But you know what? Maybe we'll step aside and we'll take a step back and we'll use that as a segue to ask Vince, our expert today. Why do folks get business valuations to start off with? Like, what are the different situations of why people might be getting valuations? And then I think we'll definitely move into like what goes into them, because I think we've sort of touched on how broad businesses can be and how many factors are involved. So let's start there. Why do people get business valuations?
Okay.
How do they end up in your office?
Yeah. So I think the first thing to think about business valuations is that they're notional. They are a situation where a company's not actually selling. When you get an appraisal for your house, it's not typically because you're selling your house. Your realtor comes and says, "How much do you think we can get this for?" Or how much do you think we can sell this for? And then you expose it to the market. And then the market decides if your house is worth it. If it sells in a day, then you were probably too low. And then maybe you don't accept the offer and you relist or what have you. But the market determines what the price of that house is based on real world buyers and sellers bidding or not bidding on the house.
Mm-hmm.
The valuation or the sale of a business is similar in the sense that you can put it to market and see what you can get. Well, when we do a valuation, what we're trying to do is mimic that. It's a situation where we want to know what the value of the business is without exposing it to market and without selling it. And those are sort of two different components that we won't go into today. But it's always for a reason other than actually selling the company. And sometimes it can be related to selling a company, but mostly it's a notional reason. So then you have, well, who would need to just know a price, a value, or what have you, right? And then the answer then is, well, people who need to assign a number for a purpose other than getting money or for giving away or for getting a portion of money. So as we know, there's the most common for business valuation is, I would say, corporate divorce is number one. So 5 shareholders, 1 shareholder wants out, and then you go ahead and you value the company based on what you think you would get for the company. And then someone gets bought out or someone buys someone out or something to that effect. The next most likely is tax planning. So the government says, I'm okay with you transferring your company, but it's got to be at fair market value. So you get the evaluator to come in, do their due diligence, do what's called a reasonable effort. And that's for any sort of tax planning. In order to paper something or to say I'm doing a transaction at a specific price, I need to know that I'm making a reasonable effort to determine that my price is at market value or whatever specific term the CRA uses for that purpose. The third most common is probably matrimonial separation, so divorce, where spouse A owns the business and is going to keep it, and spouse B has no interest in owning the business and needs to be bought out. Very similar to corporate divorce. The only real difference there is that in corporate divorce, let's say those 5 partners, they all kind of know the business reasonably well, whereas in matrimonial settlement or personal divorce, I'm not sure if that's a term you'd use, but one person often knows more and then the other person knows less. And that's a bit of an issue because then there can be disagreement and lots of black holes and sort of more fog in that scenario. Then the next most common is prior to sale. Maybe that's not the next most common, but it's probably pretty up there. So if they want to take their business to market, they don't really trust business brokers, so they want to get an idea if this is the time to sell, and they want to take their report to the business broker and say, yeah, this is what I want for it based on this person I've done work with in the past or some of his credentials that I trust, because business brokers are like realtors, they're salesmen and they get paid when they sell something, so they may want to shore that up. The other side of business brokers is the business broker comes to us and says, my client has an unrealistic expectation about what their business is worth. Can you please do a valuation so that we can list it for a reasonable price? So that's another one like the sort of pre-sale, but it's more from a different angle. Not saying I want to protect myself, making sure I'm getting a good broker price, but a broker saying we need a realistic price and our client won't believe us. And that's more common than you'd think. But when people work to build a business their entire life, it's really hard to let go of it for for less than they think it's worth. That's a real hard emotional thing. And then the last one I'd say is for financing. Last common. So a bank says, hey, someone just bought a company. I want to lend on it, but I need to know that the value that they paid for it is reasonable, and I want to be able to sue someone if they default on their loan. So I'll get you to write a report. I'll get into your professional liability insurance if so happens. And that's really how a lot of appraisal specialists. That's a lot of the reason why we're hired. So like commercial appraisal is there so that banks can have some liability insurance to buy into if the fundamentals are wrong, or to bite into in a lawsuit, or if an equipment appraiser appraises something, then they get it wrong, and the bank can go after that liability insurance, which is normally bridges the gap for so many things. Luckily, our firm's never been down that road, and so we'll keep on that trend. But those are sort of the main reasons why people will get a valuation.
So
Okay.
My question is, does the reason for the valuation change the way that the valuation is performed, and therefore maybe change what the value is? Like the result of the valuation?
Yes. Well, the only thing that will change, and so the answer to your question is yes, but because the only reason the valuation should change is because of the information that you have. So as an example, we already sort of got into a little bit with the 5 partners that own the business. If I can talk to 5 competent managers as well as their capable bookkeeper and maybe their accountant, and I can look at their general ledger and everything's organized, then I'll have, the best information possible. Like it's going to be great info. So in that instance, with perfect info, we should never really have a difference in opinion. That said, it's the information difference that matters. The other thing that can change is assumptions. So someone might say, okay, I'd like my company valued on the basis that I've opened my new location and we're 2 years in, or I want it based on the idea that our salaries are too high, and we're going to go from the salaries being 30% of revenue to 25%. And what's that look like? And where you get into trouble in terms of different values is when someone says, well, 25% is actually really reasonable based on my understanding of the market. And then someone else will say, no, I think 32 is actually reasonable. I think they're underpaid. And so you end up having this argument back and forth over who's got the most reasonable assessment of the market. Sometimes the tiebreaker is, well, what's actually happened? Well, it's been 30. So we'll go with 30 because we know that exists. So the purpose should not define it. The other reason why the purpose would define it would be because the level of engagement, again, going back to the availability of information, if you have a low level engagement, like the calculation business valuation, you're going to have less access to information. And you have basically built into the report, not necessarily a requirement, but an allowance to rely on management. So calculation valuation report is basically saying that you will rely on management representations to make your conclusion, which makes for a fairly quick valuation. Someone says, here's my company, here's my financial statements. And you say, well, why did this happen? They say, well, because of Y. And why did X happen? Well, because of Z. And then you go back and forth discussing with them. And you can't go so far as to if they say Z is this unimaginable scenario, then, your professionalism and your requirements under the Canadian Institute of Chartered Business Valuers kicks in. But outside of that, you can go with any reasonable management assumption. And that's on a calculation valuation level, so the low level report. So if you're there, the purpose is management information, and they just want to know because they want to know for estate planning. So one I didn't mention, they're thinking like, well, when am I going to retire? So they're looking ahead. That valuation will come with something really different than if you do a comprehensive business valuation report, where anything management says needs to be proven by documentation. So if they say, let's use capital expenditures as an example. So you're looking at their books and they've got a bunch of semis. So say we're doing a transportation company.
Yeah, sorry, could I just stop you there for a second? Can you just quickly explain what is a capital expenditure?
I see. Yeah, for sure. A capital expenditure is a large expense. So it would be something like buying a semi truck or buying a Zoom boom. I don't even know what that is, but I know people buy them. Or buying
a Zoom boom is like the thing with a bucket on it that you can put up in the air.
Okay, I know what a Zoom boom is.
That's a Zoom boom.
Or some, a major piece of equipment over $5,000. Some, depending on the size of the company, it could be over 30. Like a truck is considered a capital expenditure, but it's not for a big company. It's not a big deal, but for a small company, it is a legitimate capital expenditure. So you might say to management, okay, we've got our amortization amount that the accountant put in, but we know that the amortization calculation is just an accounting-based estimate. It's applied evenly for any company, whether or not they use the asset. So it's not accurate. And no accountant will tell you that it is. But then you want to make what you want to do is you want to say, okay, your amortization amount, which explains on the financial statements how much you're spending on your capital expenditures, we want to take that out. Then we want to make a better estimate of what that is. And if you say to management, well, how much do you spend a year? It looks like on average you're purchasing $60,000 worth of capital expenditures per year. And they say, oh no, we've been building up capital expenditures over the last 5 years because we want to sort of run our equipment into the ground for the next 7, and then we'll do another cycle. So what you got to do is you got to average that out. So they might say, so really it's more like 30 or 25 or what have you. So on a calculation level, I'll say, okay, great, that makes sense, right? That's based on a management representation that is not unreasonable, and we put it in there. But on a comprehensive level report, we'd say, okay, well, can we see the past 5 years of financial statements? Do you have any internal documentation commenting on your asset or your capital acquisition plan? And then can we see maybe the mileage? We might go that far depending on how severe of an engagement it is, and say, can we see the mileage on these vehicles, or can we see any proof of you selling an old Dodge? Let's just use a truck as an example. Have you ever driven a Dodge to 400,000 kilometers and then sold it for $1,500? So is your assertion accurate? So it's a lot of the same work, but it would come up with a completely different result. Whether in a comprehensive, you can't necessarily assume things; you have to prove it. You can have an assumption, but it has to be very clear that it's an assumption. It might even be a scope restriction because it's normally more like an audit than it is a management-driven document. Does that answer your question?
Yes. So basically, the answer, I thought it was a very short question. We get that all the time as lawyers. I've got a simple question for you.
Yeah.
You're like, yeah, the question's simple, but the answer is not so simple. So the question was, so different type, does the reason for valuation affect the actual outcome of the valuation? And if I understand your answer correctly, the answer is yes, but not because you're trying to evaluate it higher or lower or anything like that, but just because depending on the type of evaluation, you're going to have access to different information. And the better your information, the better the valuation. Sometimes you're relying on what the managers say, and other times you don't care so much what they say. You want to see documentation to back it up to make sure that it's, I'm assuming that's what the bank wants. That sounds like something the bank would want. I don't care that you made these capital acquisitions and you're going to ride them to the ground for the next 7 years. I don't believe you. Let's see what you did the last 5 years. That sounds like the bank.
That's right. Well, interesting enough with the bank, they kind of want to see the market norm. So what they'd ask me more for is they're saying they're spending 30 a year, but what's the norm in the market? Because they like to run on their ratios, and they've got their own sort of internal profit and loss and averages information and that sort of thing. So they might ask you to run it with a different assumption. It's very rare for banks to ask for a comprehensive level report because I think more or less they want to make sure that they're following what the industry suggests. So Kim, you probably know this better than I do. The bank's got their sort of list. Okay, this industry makes 17%, and they're doing 25. I don't like that. That doesn't make any sense. What would this company look like if it was only doing 17? Because the idea is replicability. So if a company's doing 22% and they're selling it to a new owner, and let's say it's a 20 employee sort of company, can they replicate that 22%, which is roughly 33% higher than the norm? Then the bank really wants to bear down on how much is the norm and how much does that norm suggest they can repay their loan. So a calculation would actually sort of be better for a bank than a comprehensive, because a comprehensive is based on sort of what's in place, whereas a calculation is based on what's in place plus some assumptions for what may occur.
Interesting.
You got me thinking a little bit about how group benefits providers or carriers have a big pool of companies, similar companies, and they use them as a proxy for when they're coming out with a quote for a new company to come on board and what they're going to charge for premiums. So it got me thinking about CBVs, Vince, where you guys probably start over time, you start to collect, your companies, and you can kind of see how certain companies operate. There's certain assumptions that sort of carry over. And it makes me think that there's a lot of value in a very experienced CBV because you've been figuring out companies, all their little nuances. You've got this, book of proxies, and it helps you with future valuations. Is that correct?
To a certain degree, I would say almost when we're dealing, at least in my space, with the sort of 2 million to 50 million in revenue company, the reference book is good. But I think what you find with experience is that companies in different industries are kind of like your kids. You think they've got the exact same genetic makeup, they're going to be the same, but then they're not. They're not like alike at all. They went to the same school, the same house, but they're just very, very different. And I think where the qualified CBV comes in and where the help really happens is in recognizing those differences. So you might say, we'll go back to our 17 and 22% scenario. The bank would ask, or the buyer would ask, and probably the buyer would be most interested, how are they doing so well? And one of the common things, and this is sort of a yawn for most business evaluators to talk about, but that's okay, is the change or the type of management. So a really strong manager who has got great relationships will be able to maybe get contracts at a better value than an incoming manager. But if that strong manager is also the owner, which it often is in that sort of 10 to 50 million range, you're not going to be able to transfer that value with the company. Another good example would be the same situation with a strong manager, and you have either under or overpaid employees, and knowing, why is this company doing 11%? Well, everyone's friends in this company, and as the company's wealth improved, the salaries of the people improved, or maybe they went through a boom and everyone got used to a certain amount of money they made. A bigger company or a public company would be just reducing salaries or letting people go, whereas this company, they kept it at 2007 levels and they kept on doing 2% inflation, that sort of thing. Or a good evaluator will find out how they do their processes differently. And that's a beauty, right? Because then you're going, okay, well, the 22% is not from this cool manager. It's from this administrative calculation system, or it's from the way that they run their trucks. They have a really good sort of fuel policy. So they're running their trucks a lot leaner than anyone else. They decided to invest in this technology, and they're the only, they got exclusive rights on this technology, or they just have a manual in place for managing their machines or for managing their staff. And so they're getting better efficiency out of it. And that's really where the value of a company comes in. Kim, the other thing, it is nice to be able to compare those two management people. And that, like with a business valuator, if you're a good one, you'll spend a lot of time talking to management and know them. So I normally am on, I guess, like a close to friend basis, probably a lot like a matrimonial lawyer or like a financial planner. By the time we're done the engagement, we've talked a lot. I know a lot about them. I likely know at least the number of kids they have, that sort of thing, and how their personality affects the company. Because to me, you have to know that if you're like, you absolutely must know what, if their personality has an impact on the company. Only way you could do that is by having, pretty good discussions with them. And the financial statements and talking about someone's 5 years of financial history. Just an example, if I looked at your tax return and I said, hey, Kim, what happened here? What's going on there? Oh, good job there. I'd find out quite a lot about you. And 1 year you might have made X, and then the next year you made 30% more of it. So you're having troubles at home? Like, why? Well, you worked too much last year, or something like that, right? So there's a lot you can read in the tea leaves by going over someone's financial statements. And I think the database is nice, but understanding why the data differs, which is something you really have a deep dive and a deep level of curiosity, is where it really, really matters. And not to harp on databases being bad, I think the database you should have is a numerical one, and that's good. But you can also look at other databases that are available online. Stats Canada basically prints all of everyone's tax returns, but in an aggregate data. So if you're in a trucking company, Stats Canada takes all the tax returns, boils them all down, and gives you averages. So that's all there. You have a pretty good idea what industry is, and then if you're smart with analyzing financials, you can sort of add it back. And then there's private databases that have the financials of certain companies. And then in Alberta, God love Alberta, has a really good wage database. So those things are good, but it is, again, understanding the differences and how they vary from the norm is important. So I agree, Kim, that knowing what the norm is pretty good. But then filling the holes is a real win if you can find someone who can do that. And it's not common. That's why, like, you'll see evaluators have a lot of small shops. There's quite a few small shops for the amount of work that's out there, and it's hard for bigger companies to hang on to their business evaluators because we have a lot more latitude when we don't have to be in that sort of billable hour structure, or doing work in a similar way to accountants do. When we say, on this file, I'm just going to take some time to really get to know this guy because his company's doing something pretty special, and it's not just a checklist thing. I'm going to have to maybe go visit the site, or maybe like the place of work, or maybe I'll have to have a less formal conversation with him. have a beer, just say, hey, let's talk about the company, that sort of thing. Whatever it is, to get to the bottom of that information is really, I mean, it makes the job fun, but it makes the valuation so much more clear and better.
Well, I think Kim's comment still kind of applies there, because what I'm hearing from you is that, yeah, you need to have that like, as you call it, the database of companies where you get to see them and you get to know. But how would you know if you go to the site, right, and you go take a look around and see what they're doing, or you go to the factory, or you go to wherever they're doing their technical work?
Yeah.
Like, how are you going to know what they're doing different that sets them apart unless you have that experience where you've seen, 10 other companies, and then,
Yeah,
Absolutely. Kim is
might
right.
not know what their secret sauce is, right? They know they're doing well. They know they're doing something differently. They might be more profitable than their counterparts down the block, but maybe they themselves don't know why.
Yeah, I think business owners sometimes think their special sauce is something different than it is.
Right.
They may not realize they may be doing something really great and take it totally for granted and think something else they're doing is really important that actually does nothing.
Yes. And going to the site is interesting because people love talking about their business. Like you got me talking about the farm, and we were on it for how long, and I could have gone on and on and on.
Yeah.
Because it's something you do all day. So if you can, it's almost like a question, even like a small question about a business, especially if you're right at the business, and you're like, how many hours you got on that Zoom booth? And then and they'll go on. They could go on for an hour. And then you see another piece of equipment. Oh, how are your rigging mats? And then they'll go on for a long time. So people do love talking about their business, and that's kind of why a site visit's good. And Kim is 100% right in the sense that collective knowledge about companies and how they run is absolutely huge.
Yeah, I can see how that would really make the differences stand out. If you've seen a few, then you see, oh wait, this guy wears his shoes on the wrong feet. There must be something to it.
The CBVs are true detectives. They have to be able to also spot lies and maybe more like missing information, not necessarily lies.
Yeah, when I started my career, I used to get really fiery because I used to get lied to all the time. I thought, geez, went into accounting to do this, this honest thing. And I thought when I, said I'm never going to step foot in the CRA again, I would stop getting lied to. And and then I realized I get lied to every single day. Like this, it's not necessarily, no, it's probably lies. But after a while, after you get, over it, which took me a few years, then you get into looking for, to recognizing the lies. They're very common. It falls into a reasonable pattern, but also you expect a certain type of lie. And if you don't get that lie, then that's interesting. So there's sort of a set of answers you can expect from any sort of question or any matter. And when you hear the truth, you know it because you've seen it so many times. Of course, there's always room for refinement and improvement. But yeah, there is a lot of lying, and there's the one thing that you don't have in most conversations of getting lied to is the financial statements, right? So things like, if my comment earlier about your revenue went up by 30% last year. How did that happen? And they say, oh, we invested more in staff. So, I'll just go to the financials. They're like, well, your management fees are down and your wages are down. Was there anything else that happened? Oh, geez, I don't know. Maybe we did more advertising. And you get the pattern, right? There's so many things to go on that the lies that might come across, and maybe they're not lies, they might just be misinformation, not in the media sense, but it must be just the manager might not quite know. And in that sense, they're not true. They're not nefarious lies. They're just someone trying to fill the hole. And if you can even help them fill that hole, then you come up with the right answer. So we do have some proper backing and some proper proof to sort of suss out what's going on in the company. based on the financials. And it's just such a huge advantage to have that.
I want to return to the acronym that Kim keeps calling you a CBB. What does that stand for, and how did you get to be one?
Yes. CBV stands for Chartered Business Valuator. I think my mom still calls me a certified business valuator, and most people still do. But it's sort of, the CBV came into existence with the help of the chartered accountants, which are now the chartered professional accountants. It's a postgraduate program, about 3 years after school. Most people have their CPA after. I went for my CPA initially, and I walked into the office of a partner one day and I said, I'm really bored and I'm quitting unless you give me something else to do. And they said, sure, you can skip over this. That was a ways through it. You can skip over this and just go straight to the CPB. So that's what you did. So it's normally, your BCom, so 4 years of school and then 3 years of school afterwards. So it's 7 years of training to get there. And then often you'll have the CPA on top, which is 2 years.
And what do you bring then? What do you learn that you bring to business valuations? Do you learn the different considerations? Is it all accounting? Is it management? Is it a bit of all of those things?
Let me just preface that question, Vince, by saying we don't learn a lot in law school that actually helps us in the practice of law. So it'd be nice to know that somebody learns something that's related to what they do.
Yeah, that's a good point, Evan and Heather. Thanks for the question. So it is interesting that our CBV really covers almost everything we do in our Bachelor of Commerce. So that's what the Bachelor of Commerce is designed for, is so you have a really good understanding of how businesses work, and you have an understanding of all the aspects. So you'll need to know your accounting, you'll need to know your finance, loans and that sort of thing. You need to know your human resources and the laws associated with that. You need to know your productions of operations management, how a company works and how workflow occurs and that sort of thing. And what is the other ones? Not getting sued. I guess we don't do a ton of that. We do take a law class in business, and you go through sort of all of the main considerations of a business when you go into it. The one that they don't really cover is personality. And they do a little bit, but not a ton. And so, yeah, your whole collection of what you're doing is really drilling down on personality. And it's almost like a bit of a psychology experience, because you're like looking at the human experience and how that transforms into building a company, how well that company stands against other companies. And again, why is it different? So how does the manager lead that? How do the systems lead that? It's very, very holistic. The really common term that people use is a SWOT analysis. So what are the strengths of your company? What are your weaknesses of your company? What are your threats and your opportunities? So if you're looking at any old company, you'll go, okay, well, this company's got a really good salespeople. They have a lot of experienced staff, that sort of thing. And then you always have to look at it through the lens of transferability. So we're doing our SWOT just for value of business. So we have these great things, and then we've got to boil it down to how transferable are those. So will the staff go with a new owner? Is the sales department just one guy, or is it a group of people? Is it replicable? Is it something that can be trained? Is there a system in place? Then we go to our threats, and we'd say, what's come out in the last few years? What are the competition? What's the competition out there? Or what are the regulations? What kind of regulations have changed in the last year? So in Alberta, a really common one would be royalties. Royalties have gone up, so profits are smaller. Or it might be something like if you're running a big salon and you're a hairdresser, and all of a sudden it takes 4 years to become a hairdresser, not 3 anymore. So then your availability of staff is going to be lower. So the threats are numerous and many. And just like we were talking about before, doing the shop visit or having a beer with the client or what have you will lead to that, right? You'll say a common question I like to ask is, what keeps you up at night? why? What would cause you to lose sleep over this? And then that's when you get sort of the ball of yarn sort of unwinding. So there's our sort of our threats. Our weaknesses would be something more like the opposite of a good sales team, or something like we have a really high rent and we're locked into a rental contract. That can also be an opportunity if it's out there. Or we have some, we've had a few lawsuits and we're getting a bad name right now, and that's a sort of a weakness of the company that can't really go away anywhere, but it'd be good for a buyer to know about it. And then an opportunity would be something like they're allowing, using our hairdresser example, they're allowing hairdressers to do more at-home haircuts, or there's a new technology, there's a new razor out there that allows you to do haircuts in less time, and there's a patent on it, or there's an area agreement where someone can't actually buy the razor. That's a hairdressing example that there's typically not a lot of value in them, but I think it's just a company that most people understand. The type of company, rather.
So I think associated with that, you were just talking about the SWOT analysis part of the valuation. What is the essence of what drives value for a business?
If I were to say one thing, it would be for my kind of clients, like 2 million to 50 million in revenue, I'd say it'd be transferability. That would be number one.
Like
other than the obvious ones, like revenue and profitability, we assume those are in place.
Right.
But the transferability.
It's not like on Dragon's Den when they're just like 3 times revenue. That's how much this business is worth. That's not what you're doing.
I can't stand Dragon's Den. Those guys drive me insane. They're like, no one would be on Dragon's Den if they had a going business. It's hilarious. So when I first started watching Dragon's Den, I thought, this is cool. They're going to see some new products, and then they're going to do their own internal valuation, and they're going to see what they can make of this product. Whereas Dragon's Den is basically asking these people to buy their established companies, and you don't go on national TV to sell a company that's already making you a ton of money. So I don't even know what to get out of it other than some promotion of the company. But yeah, they come off as venture capitalists, but really they're established, just buyers of businesses is really what it boils down to. So it's a weird format, but it's wildly successful, obviously.
Okay, so that's a bit of a myth bust there. It's not, you don't just take revenue or profit and apply a multiplier and that's the value of your company. Obviously, there's a lot more to it.
Well, especially for an emerging technology, right? Like that's, if, a classic example would be if you went to Bill Gates. If Bill Gates went on Dragon's Den and they said, well, how much does your company make? He'd be like, oh, negative $30,000, whatever it cost him to build the first computer in his garage, right? You wouldn't do that. If you were a non-Dragon's Den, like a real venture capitalist, what you do is you'd assess the market, you do a business valuation more or less, and then you'd make the offer on that basis. So that's where Dragon's Den sort of gets me crazy. But I think there is sometimes, a revenue multiplier scenario. So they're using the metrics. It really does seem like they're doing it for entertainment purposes. They're using the metrics, but they're not applying it to real things. So you would never, like you said, you never ask Bill Gates how much his computer or how much his revenue is when you're looking down, the scope of the world's first personal computer. It's just not, and that's sort of what they're doing there. Just looking the gift horse in the mouth and using some valuation lingo.
Right.
Yeah.
Yeah. There are different formulas that are applied to different types of companies out there, right? So you guys would look at somebody comes to you with one company and then you instantly know, I would use this sort of calculation to calculate the value of this company, whereas a different sector company would have a different type of mathematics applied. Is that correct?
It is, but it's normally a bad thing. So just trying to think of the ones. Accounting firms often sell on the basis of a percentage of revenue. So the assumption there is that the clients will be, again, transferable. And you can just take these clients and put them into your company and you'll be fine. But it's quite dangerous because that revenue doesn't also necessarily equal out into income. Let's say, okay, we're going to buy your accounting firm at 1 times revenue. But the net income is only 15% in this company, whereas the average accounting firm is 20. So either you say, well, let's just change our multiplier from 1 times revenue to 0.75 times revenue because you're making 15% as opposed to 20, so we're 25% different. You either do that, you might end up doing that, but really in that instance, you're just doing it based on income. You're adjusting your revenue multiplier to reflect the difference in the income. So I find that it's almost always a really good warning sign when you see a revenue multiplier applied to anything, or an EBITDA multiplier when you see it related to anything, because what you really care about as an investor is how much money am I going to get out of this business on a standalone basis, if the business stands alone, every year. That's the question you need to ask, not how much revenue it is and what could I maybe do with that, or what's the term EBITDA is earnings before interest, tax, depreciation, and amortization, which is basically, so you have your net income, and then for income before tax, then you add back your amortization, which we were talking about earlier, which is an accounting adjustment based on your capital expenditures. You add back your tax. You add back your depreciation and amortization. So the DA and EBITDA is the same word twice, just fun fact. Depreciation and amortization are synonyms, and they are the same thing on the financial statements. So it should be more like
we tell people to cease and desist all the time. So those words mean exactly the same thing.
Right.
Stop and stop.
Double stop.
And so when you add all those things back on an EBITDA, for example, and I'll go back to the revenue thing after Kim, but when you add back tax, you add back depreciation and amortization, and you don't deduct something in place of it, then you have an incorrect calculation. And let's say in an accounting firm, your DA or your depreciation and amortization, they're very small, so they doesn't really matter so much. But
Yeah.
what if you have this accounting firm that is really, and there is one in town that's really, really high tech. They have screens the size of my windows, massive screens, and they have people working side by side. It's this crazy sort of like tech accounting firm. Now their DA would be really high. And so someone came in and said, okay, well, your income is 20%. Oh, and your EBITDA is like 35. That's great. That's so good. But they have less staff because they're really efficient staff based on these massive computing systems that they have. So really, the average accounting firm, to say their depreciation amortization is 5% per year of their income, like their real capital expenditures. Whereas this firm is 15, they're really still only making 20, but they just have less people to deal with. So it's a nice firm to own, but it's not that much more profitable. So that's where you can really sort of get out of joint when you don't have an income-derived valuation. Same with the revenue thing. They, oh, geez, $2 million in revenue. Well, I guess the company's worth $2 million because it's got this accounting firm that's got $2 million in revenue, $2 million in revenue, and you're paying 100% of the revenue for the whole company. But things in there that could be an issue is that the shareholder could be underpaying himself and doing a whole bunch of work and driving that revenue up, and then the shareholder leaves the company, and all of a sudden you got to hire 5 staff. I used to work with a guy named Ralph. He worked. It was insane. Like, it was tax season would start, and his face would be like red, like pretty red. By the end of tax season, he looked like he was gonna die, and his face was a tomato, like in a really good garden tomato. We're not talking about superstore junky tomatoes. Like, this guy was just dying. So that would be another way that you would have an error when you're using the revenue multipliers. And they often come from concepts that do make sense. And then in my mind, they get adopted by unscrupulous sellers. The business brokers, a lot of my clients are business brokers. They send me work. I appreciate them. They're salespeople. They're doing things that are important. They provide an important function. They do sometimes try to do their best job selling, and they apply valuation techniques that don't make any sense, like a revenue multiplier. Or there's this idea that inventory is always an additional amount on top of the value of the company, which is, I mean, if I had to buy a company and then buy the inventory on top of it, that would get pretty expensive.
Well, yeah, if you don't, how valuable would a valuation be if it didn't include the inventory that the business owns?
Yeah, it is a thing. So I'll tell you where that comes from. Sometimes it happens in a company. A pharmaceutical company is actually a really good example, where they buy too much drugs. Or they, didn't think I'd be saying that phrase on this podcast, but they buy too much pharmaceutical inventory, and then they go to sell their company, and they haven't gotten rid of that inventory yet. And so normally a company of that size, let's say it's $5 million a year, and normally your inventory would be $1.2 million a year. But they done bought too much drugs, and now they have 2 million, or they have, let's just say they have 500,000 in excess inventory. So the value of their company is whatever their valuation is, plus their value of their excess inventory.
Okay.
So
it's like excess of what they would use in a given year.
Yeah. And what a reasonable, or, the industry standard would be, or whatever they would need. And so that's the idea of the redundant asset, where you have something, a little bonus. So I valued a company that had, they built modular trailers, and they had a down year. So they didn't want to lay their guys off. So they just kept on building trailers, and they weren't selling them. So they had literally $3 million worth of trailers in their yard. And they said, well, we'll sell you the company for $2 million. We actually have, we're only going to give you $500,000 worth of trailers. We'll just sell the rest of our trailers on our own. That sort of thing. And that's where this idea of different valuation metrics applying sort of goes off the rails, because you have always the main consideration of the amount of income after tax I can make in a year. And then you have, other ways of looking at it that come from other things. The revenue multiplier thing, Kim, comes from your industry, where you can really easily transfer your clients over. You say, oh, and we've talked about this at length, right? Where you say, okay, I've got a book of business, I'm managing this many clients, I'm just literally going to turn them over to this person, and there is no work, and it is streamlined. But imagine applying that revenue multiplier to a manufacturer of building trusses. Well, you have this revenue, so it obviously makes sense. But then you're taking out all the expense considerations. You might be taking out locational factors, like their trucks have to drive farther because they're in Nisku, whereas the company that you're comparing to that's sold on a revenue multiplier basis is right in the center of Edmonton. Whatever it is, it's not great. But in your industry and in the insurance industry, it makes sense. But you have to make sure it applies. And even in the insurance industry, that's starting to fall apart. So revenue multipliers are getting out of control because they're not tempered by the income considerations of the company. The other thing with revenue multipliers, and man, I didn't know I could go on about revenue multipliers for so long.
Because I mentioned Dragon's Den. I'm sorry, Vince. I got you all worked up.
No, but this is so important, because what do you see when you're looking at buying a business? Revenue multiplier. Yeah. It's like, that is the metric that people know and talk about. So getting all this information from you is so valuable. So keep going. Don't stop. What else is wrong with revenue multipliers?
Okay, where was I at? I kind of lost.
The insurance industry, and they're getting out of control. Yeah.
Yeah, the insurance industry is getting completely out of control, because what happened was they were saying that they were at, I forget what they're at crazy numbers right now, but for a long time it was 1.5, and then it went up to 1.75, because initially they said, well, we're going to, let's just say it's 1.5. I think it's quite a bit higher now. But at 1.5, they said, okay, I'm buying it on a revenue multiplier of 1.5 because I can integrate it into my company. Okay, that's fine. And then someone said, wait a second, you can integrate it into your company and cut costs. So I want an extra 0.25. I said, okay, fine. Well, you know what? You're right. You're right. You got me. It's 1.75. And then they said, hold on a second. You're going to get more clients because you're going to grow as a company. You get a better reputation. Because now it's not going to be Bernard and Jonesy. It's going to be Bernard, Jonesy, and whatever. And you're going to have a better reputation. So by buying my company, your company's getting a better reputation. And he's like, oh, yeah, you know what? It is probably worth an extra quarter point. So now it's 2. Got a 2 times multiplier. And then it gets to 2. And then they realize, geez, you know what? It's not actually that big of a benefit from being a bigger company. Some of our clients like dealing with a smaller company. So these sort of add-ons to the multiplier don't materialize in the way that they think they're going to when you get too speculative. And that's what, when you take out the income point on it, like if they would have sat back and said, hold on, let's actually do a projection. Let's see what happens if we do this and what our uptake is likely to be. And maybe we'll meet in the middle at 1.875 or 1.8725 and see what could actually happen here, because there is a risk associated with this. Yeah, I agree that it's likely that we're going to have a big rep and we're going to get more corporate clients, or we're going to get whatever, but maybe that won't materialize. Or if we're saying it is, we've got to apply a slightly higher risk factor to that. And so going back to the income would be good. Doing it, maybe a projection forward would be good. But the revenue multiplier can get wild on you if you don't go back to the fundamentals of how much money am I going to make from this company on a standalone basis if I buy it, and then go into your special interest. That brings me to sort of another point, is that that Evan brought up earlier, and because I was going on so long about that, and as you can tell, I can talk if I try. The valuation one of the assumptions often is that there is no. This is an innate assumption in a valuation, is that the valuation does not consider benefits of the special interest purchaser. So if Joey's Trucking buys Joey's Zoom Boom, then we would think that Joey's Trucking would get the Zoom Boom work from the Zoom Boom company that they're buying, as well as more trucking work, right? So they'd say, well, the Zoom Boom clients are the same as the trucking clients, and they have 10 clients that we don't have, so we'll probably get all their work now that we bought the Zoom Boom company. So the trucking company is going to grow, but we can't value the Zoom Boom company that's being acquired on the basis of how Joey's Trucking is going to do on top of it. And that's called the special interest purchaser consideration. That's something that we don't do in valuations, but we see a lot of folks, especially probably more so in matrimonial, because they'll say, well, yeah, but if she sells her company to anyone, they're gonna benefit from the company in this way and that way. We got to say, well, they're not, though. They're keeping the company, and we're valuing the company on a standalone basis, and the owner is not going to get the special interest considerations. And again, when we value a company, unless we make an assumption, this is where I'm tying in what you said earlier, Evan, does the purpose have to do with the difference, in the value conclusion? And it can, if you agree to do special interest purchaser considerations, say that 10 times fast. If you have those in place, then that would result in a different set of information and set of assumptions, and therefore conclusions. But in a matrimonial aspect, you value the company on a standalone basis because that's the asset that's transferring off the MAT property statement.
Right. And sort of going back to what you said at the very beginning, is that you're trying to provide a notional value of what it would be put on the market or sell for without actually selling it or putting it on the market. So that wouldn't necessarily account for that special buyer or one particular buyer. You're looking at buyers, generally the market.
That's just it. You're looking at the market on a standalone basis and not a particular buyer. But that's probably the most common sort of misconception. And that's some of the work, I'll say often, and this is a little bit smart alecky, but you'll say, I can only value the company one way. And that's essentially saying I can't value it on the basis that this and this is going to happen. That more closely relates to when I go suit shopping. I'm like, I'm going to have bigger arms next year, and they say, well, I can only make your suit for today. So the same thing with the business. You can only value the company based on the information we have today, on what we know today. And if we want to make a whole bunch of different suits, then we're going to have to see a whole bunch of different people, or different looking same person at different times, sort of thing.
So not to go ahead and layer another layer of complexity on all of this, but I know some of the examples that you gave were pretty straightforward. Like, I understand there's probably not a lot of psychology or emotion involved with bank financing, right? That's going to be a fairly neutral ground. But in divorces, say, or corporate divorces, I'm assuming there's divergent interests sometimes. So are there common areas of disagreement in business valuations, or how does a neutral like you address those things? I think you've touched on it a little bit already, but I'm going to ask if you could drill down into that a little bit.
Sure. I'll start with saying that my favorite books, and not when I was a kid, but when I got into business valuation, it was about 3 years in, were Sherlock Holmes books.
Okay.
Arthur Conan Doyle writes just some fantastic stuff, even for someone in their 30s or 40s. Like they're just so good. And one of the things that happened in Sherlock's book, or in Arthur Conan Doyle's book, Sherlock goes to a butcher, and he's trying to find out if someone had come to the butcher shop yet. Somebody he's trying to follow. And he said to Watson, Watson, I bet if I ask this butcher, can I see your ledger? He'll say, go pound sand, get out of here. So instead he sort of made a way of kind of baiting the butcher. And he said, I bet you only sell, 3 sides a day. And the butcher said, yeah, right. I sell 5. He goes, I don't believe you. Show me your ledger. Right. And so the butcher showed him his ledger. And there you have it. It was easy information. So to a certain degree, there's some sleuthing like that to be done. There's a little bit of baiting to be done. And it's important to be able to draw information out of people. Now you can do it in a very friendly way, or you can do it in a more of a determinative way, in the sense that you're saying, well, the person paying for the business or buying the other partner of the business is going to want the value to be lower. And the person who is, being bought out wants the value to be higher. That's kind of an obvious one. But again, where you sort of come down on finding that out is in your art of reading the tea leaves, having those financial statements to go on, and understanding someone's interest going in, right? To make it a little bit nicer for that person, to describe to them that you're wanting to know the interests of both parties, and that you're going to bring everyone's information to the table. That's probably pretty important.
Mm-hmm.
But I don't think I'm quite answering your question, Heather. Can you ask it again or rephrase it?
No, but I kind of like the path you've gone down. I think it's interesting. Are there common areas of contention in any of these valuations? But I think what you've said is really helpful and interesting too.
The common areas are personal expenses, which is, I find, one that people really get hung up on. And one of my favorite lawyers, I won't say it was, but older lawyer, said, how much can we really be talking about here in terms of how it affects the value of the company? And so people will get really hung up on it, but I think that the important thing there is to give, regardless of how small it is to give that credence. And I think the reason why it becomes so much of a focus is when the one spouse isn't in the company at all and the other spouse is. And the only thing the other spouse ever sees is the one spouse buying dinner with the corporate credit card, or sees the one spouse, putting having the company truck and buying gas out of the company. And so Mr. or Mrs. business owner and business operations manager knows so much about the company compared to it. And they know, what they're supposed to be running for margins, and they know how much it costs to keep the lights on and the business afloat, and so on and so forth. And they are in a superior knowledge position, right? And that sucks for the person who's not in the company. That's not fun. You feel very powerless. You feel like there's a big black box, like things can be hidden. And so you go to what you know. You see these expenses going through the company, and you want when you find out the quantum of it, it might not even be that. Sometimes it is. And often it's of significance, but it's for the amount of time and effort it gets. It's not a major piece of significance. In terms of a company valuation. It's different with guideline income, but with company valuation, it's not typically a big deal. But focusing on those personal expenses really gives that person sort of credence to the knowledge that they do have. You say, hey, I'm going to spend that hour with you. We're going to go over everything that you think's in there. We're going to go over the general ledger. We're going to suss that out. We're going to show you why it is, why it isn't in there, and how we can answer all your questions on the engagement. and maybe there's some, a good find in there. And then we get to add that back. We get to add it to the value of the business, and that person's, the small area of knowledge gets recognized. And that can go a long way to help settling a matrimonial dispute, especially with the business being a bone of contention.
Yeah.
Yeah.
We see that. I just learned something just now. That's called Sayre's Law.
Oh.
In any dispute, the intensity of feeling is inversely proportional to the value of the issues at stake. That's why academic politics are so bitter, is the end part to that. But that's called Sayre's Law. It's like, the tempers were so high because the stakes were so low, that type of saying that I'm sure we've all heard. And I see that sometimes you have to have a word with the client to say, like, is it really worth it to fight about this couple $1,000s when we're talking about overall $100,000? You want to die on a hill worth $2,000?
Right.
Yeah.
But I see what you mean, though. Like you brought an interesting kind of psychological perspective to what's at issue there, of the outsider seeing something they understand and looking for justice on the principle of, like, I don't understand all the other weird stuff and about the business and the industry, but you went to lunch every single day at the same restaurant, and I feel like that was just unnecessary.
Mhm.
Not that would necessarily, half of that.
They know it's there.
Yeah.
They know it's there, right? And how can they trust you if such an obvious thing, like, like you said, they go for lunch. If, Sammy's Sandwich Shop is on the general ledger 365 times a year and you don't adjust for that, how can someone trust you?
Yeah.
And the answer is you haven't, either you don't care, or you haven't done your work. If someone's brought that to your attention, you're doing it. And I find that's a really, really good one.
Yeah.
The other area of contention is probably that capital expenditures item, where someone says, and it's again, it goes, that's actually funny how full circle it is. One person will get advice. They say, well, no, a company's valued based on EBITDA. And then they say, well, no, the company doesn't actually make that much money. Well, I've done my EBITDA, the side says, I've done my EBITDA calculation.
Yeah.
Company's making $400,000 a year. And then I said, well, yeah, but we buy 200,000 worth of equipment a year. So really there's only 200,000 left over at the end of the year. And I take a salary of 200,000. So really the company isn't making any money on a market basis. It's really just worth its assets or something like that, right? It's these valuation principles that are stuck in people's heads, that people either get bad advice or don't understand that, yeah, that's probably a better way to put it. Don't understand that the accounting, that the financial statements don't tell the story. And that's why our reports are so long. That's why we go to school for an extra 3 years, because the financial statements really don't tell the story. And cleaning the financial statements and putting them into the perspective of a potential purchaser and what they'd be looking for, and the reason why they would buy the company and the money that they can expect to have at the end of every year is the big one.
Right.
So I just had one the other day where they said, and I'm using the numbers from that example, they said, well, there's $400,000 a year. I said, well, yeah, but you guys don't pay your both of the shareholders, they're matrimonial. You guys don't pay yourselves a wage. So we got to take this market wage. Well, no, it makes $400,000 a year. How is it not worth 200? Well, someone else bought this, they have to hire someone, and then the company wouldn't make them any money, and so they wouldn't be willing to pay anything for it. That would be the other major contentious area.
Well, and that speaks to what you were mentioning earlier, that transferability really drives value, all other things being equal. And that's especially for small businesses. And I mean small in number of personnel, not necessarily revenue. That can be a huge challenge, because if you haven't structured your business so that somebody else can just step into your shoes and take over right now, that makes it very difficult to sell.
Mm-hmm.
Because is the value really there, or is it too much tied to the principle of that business? So, I hope one takeaway for any business owners who are listening to this is, try to McDonald's-ize your business as much as is reasonably possible. And, I think I've said this before on this podcast, but, I don't know if you know this, Vince, but there's 2 temperatures that the McDonald's grills have. Do you know what they are?
I don't.
It's on and off. That's it. The grill temperature is set across all the McDonald's in the world. They've figured out the optimal grill temperature, and no employee can change that temperature. They can't screw that one up. It's just on and off. That's the cooking time for the patties that are uniform in size, et cetera, et cetera. So, and people may think, oh, well, I'm not McDonald's. I don't even have a grill. And fine, but that's not the point, right? The point is, can you apply those principles to your business? And the more you can do that, the more it can be, turnkey, then the better your chances are of getting a good valuation from Frost Valuations and selling it and getting out and retiring and buying a coffee farm in Costa Rica or Puerto Rico. What was it? Puerto Rico?
Costa Rica.
Yeah.
Yeah, that's just it. Yeah, transferability is key. The other, if we're on the sort of transferability thing, the other thing is growing your transferability internally. For if we have any sort of estate planning folks watching, it's a really often overlooked thing to do, but to pick 3 or 4 guys or girls or cats or dogs that you think can, take over the company in however many years and start that, start your company with that in mind. So if you're 20 years out, and even Frost, we do that. We have a 20-year plan. And we say, do we have enough people here that would buy this company? And so if we say we've got 7 people here that may, buy our shares off of us, well, one of them's going to quit. And one of them's going to switch professions, and one of them's going to get poached or whatever. So now we have 4 left, so that we're in a good stage, and then you just go on and reevaluate it. So that's another aspect of transferability.
Succession planning.
Yeah, absolutely. Yeah, that's in there. But I find that people think of succession planning as that's the piece that they always miss, is the internal succession plan. And they'll just think, oh, maybe not. I think you mean internal company succession planning? Yeah, you're right. Yeah, so just doing that properly and keeping your finger on the pulse on that, and that's another way. That's what I love about business valuations. They always come to these full circles. If you're building your company with managers in mind and someone that you want to sell to, then you start structuring your operations so they can take over. And so if you hire somebody, say, listen, I want you to take over the company soon, or within 5 or 10 years. You're going to start thinking, how do I transfer this company? How do I transfer my knowledge out to this person? And then you start systematizing it. Then you start teaching it down, and then you teach it to more people, and then your company starts building an actual knowledge base internally and ingrained. But also, you'll want to write it down if you want to be really safe about it, so that you can train it to more people. And knowing from training people under me, the more you try and secure your company for sale, the more people you hire, and the less time you have to goof around and explain things verbally. So then you start turning things into manuals. I do videos, so whenever I'm correcting a file for someone, I'll throw in the Zoom, I'll do my corrections, say, oh, look, you messed up here. I'll throw in a joke or whatever, and then we have ingrained manuals right there and right now, and that's a huge key to transferability and company value.
Nice.
I mean, who doesn't want to walk into a company? They say, yeah, you can buy this company, and there's 5 guys who can do the job that the most qualified person can do right now. That'd be a dream. Whereas, welcome to this company.
Good luck.
Once I leave, we don't really have anyone.
I'm already here.
Ralph's gone.
Oh yeah, exactly.
Right?
Yeah. Oh man, when Ralph left, that was a nightmare. We traveled so hard.
I'm sure.
He burnt out, and he left. And we had to hire guys from Saskatoon. And this one guy was a nightmare. It was absolutely unreal. Wow, good callback, Heather.
Yeah.
How are the manuals for the farm coming?
Well, we do have them actually, but I hired. So the people who sold me the farm, their daughter has a seems like a sort of like a master's in agriculture. So they sold me half their farm basically. And so I hired their daughter to be my farm manager. So, I mean, I basically got the whole family's knowledge from hiring her. So that was a real lucky one. But she does document and do manuals for everything and all that sort of thing. And she's passing it on to our other farmers that are down there who are
Nice.
they're pretty good too. But that was the equivalent of the guy who buys the business, and somehow there's like, you know, an expert just floating around ready to take over. So that was a streak of luck.
Nice.
Yeah.
Well,
That leads me to my very last question, sir. I'm just going to get it in here because I only have one more. But do CVVs specialize? Do you have an expert in a specific area? Because I'm thinking, how does somebody shop for a CVV? Can they just kind of like throw the dart, or do CVVs specialize in a specific type of company or something?
They can. To me, a good CVV understands the fundamentals of business valuation. So there should be some, you know, some really good fundamentals that will allow a CVV to value almost anything. There are some markets where specialization is probably better than not. But I find that even when you specialize, so IT, for example, I think I'm probably one of the first people to have appraised an app in Edmonton, and I've done a few of them, and no one else that I called and talked to about it had ever done it. But you always end up going back to how much income is it going to make for us? And but with that in mind, apps like insurance companies are a specific sort of industry where they might have an idea, like it's sort of like valuing apps. So I guess, yes, they do specialize, not often. And things like emerging technologies are something where it's a very, very small knowledge base. But that specialization will only last so long because someone else will do another app job or someone else will do what have you. I know some people like to do, there's one company that does dental valuations, but that's because they also do dental equipment appraisals, and that's all they do. And they're not CBVs or anything like that. I'd say as a rule, some business valuators are better in different industries because they have more exposure, but specialization isn't highly common. If you're dealing with emerging technology, you want to make sure to go with someone who's at least valued a company like that before.
yeah.
Does that answer your...
Yeah, I was thinking kind of about like the new spawning industries out there, like cannabis and crypto, and these are areas that would take a lot of time for CVVs to look through and figure out what the heck are these people doing and where's the money going to come from. So
Yeah, just like tech startups in the late 90s and early 2000s would have been. Do you know what Elon Musk's first company was?
PayPal?
Yeah, that's where he came from. It was like a bunch of college buddies started PayPal, and now he flies rockets to outer space.
Well, Kim, if you had given me a chance to guess, I would have guessed that you were going to ask your classic closing question. So I'm going to have to ask it. And she says, as the money person, I always know that our listeners are wondering about how much does a business valuation cost? So can you give us a range or an idea of how these are priced out?
Well, Heather, how much would it cost to not have a business valuation? That's the better question.
Excellent, Heather. So true. Get a business valuation today. They typically cost between 5 and 6. I think that the non-public firms, so not the MMPs and the KPMGs of the world, are similar in price.
$5 and $6. That's great.
Yeah,
Fantastic.
that's a really good deal.
Yeah.
I don't make much money. They're between 5,000 and 6,000, and that's a low-level valuation. So the calculation based on management assumptions, those are appropriate for tax purposes, for internal decision making. So corporate divorce, as long as it's friendly and everyone's agreeing. They're appropriate for most matrimonial purposes. They're appropriate for financing.
Okay.
They're not likely appropriate for court, but I have seen them go to court. My calculations have gone to court.
Wow.
And it's the only reason why I think everything was okay with them is because the other side also did a calculation. But if they were to do an estimate, it'd be bad. An estimate is typically about 2,500 on each side. So it goes 5 to 6, and then it would go 8.5 to about 9.5, and then it would go a comprehensive. Some CBVs don't even do comprehensives. I do some work for First Nations, so they always want comprehensive, and those are normally minimum starting at 15,000 and up. And
Okay.
the value for money from an independent, like a smaller shop, so for not a national firm is pretty significant. I know their prices are typically 50% higher than ours, and most of us are Court of Queen's Bench tested at least once, and so there's good value for money there for sure.
So the starting at 15,000 up, that's the one where you like move in, right? You like
That's
live with the directors for 6 months.
That's right. Yeah. You have beers with them every Friday. They're your best friend.
Yeah.
And then,
the real fine tooth comb sort of thing.
Yeah. And lots of market research is the big one there. And those aren't really necessary. The estimates, the good court ready document, and there's nothing, you don't need anything more than that typically, unless you have a special funding requirement, which most government things do.
Okay.
Well, I don't have a last question. I guess I already asked it. My last question was my last question. Vince, was there anything that we didn't cover today that you really wanted to get off your chest?
Well, I think we talked about quite a few things. I'd only summarize to just say that understanding a business is more about understanding the differences and understanding the personalities than anything. And I don't mean the differences just in personality, but the difference in technology, why they're better or why they're worse. And having that long discussion, having a relationship to the point where you're basically friends, or on a friend level of communication. And it doesn't have to necessarily be friendly, because it isn't always. But having a point where you know what's going on in the company a real way is crucial. I don't think you have a business valuation without having that. If I were to complain about something, it was that some valuators, including some of the smaller shops, will do evaluation without talking to management. And if you want to start a fight, that's a great way. If you want to go to court, not talking to the manager. Imagine what we just talked about with the spouse who's not in the company saying, I want to know about these lunches, or I want to know about this truck and how much gas is getting put through the company.
Yeah.
Imagine your company gets valued, and the valuator has never heard your voice, has never sent you a question, and it's all coming through documentation and maybe discovery or whatever it is, and that you don't have the capacity to talk about what makes your company tick. And I don't know why evaluators would do that, because to me, that's a massive professional liability. You could have a huge liability there. Our institute requires that we get the information if it's available, and skipping that step just because it might be a little tough is a disservice. But also, it's just like any bad thing. If you do the opposite, it's awesome. You can get a really great valuation, a really good understanding of the company. And if you're buying a company and you have a valuator that does that, and they can convey to you that information about the company that you would never get. You never get that level of information from the company, even if you're buying it, unless you have someone going in with the ability and willingness to get as much information out of it possible to really come up with the best conclusion. That's a real beauty. So the opposite's really bad, and doing it is really quite good. And also, I think that's what separates evaluators in terms of quality. High quality just knows more about the people and the processes of the company, and really cares to know and really wants to know.
Yeah. It makes me think of something you said earlier, like the better your input is, the better your output's going to be. I mean, it seems almost as simple as that in a way, despite lots of those things being pretty complicated.
Yeah. Oh, and joint retainers are so nice. Like when you hear both sides, same thing. You just have more inputs, right?
Yeah.
you've got more, it's like having the financials plus comments on it, and then you can go into it. It's really quite good.
Well, Vince, thank you so much. Oh, I'm cutting you off, Evan. Did you want to?
No, that's what I was going to say essentially the same thing. I guess I would only add, like Heather said, or maybe it was Kim, that you're the second business valuator that we've had on here. And I was thinking before we started, am I going to really learn something new here? But yes, was the answer to that question. So I just really appreciate your depth of knowledge that you've brought to us today. And I thought it was great. I learned a lot.
Thank you. Thanks for having me on. It was a great chat. I don't normally talk at length. I'm normally the listener. Also a good skill for evaluator, be a good listener. So yeah, thanks for having me. Thank you very much.
Well, we appreciate your time coming on and being a talker today. Thanks, Vince. This has been another episode of Access to Justice. Thanks for listening or watching, however you've come to us today. If you have any questions you'd like us to address on the podcast, please send an email to accesstojustisepodcast@gmail.com. That's access2justicepodcast, and we'll do our best to get you an answer on an upcoming episode. Thank you. Bye-bye.
Bye.
Any information in this video is general information only and is not, nor is it intended to be, legal advice. Watching this video does not create a lawyer-client relationship. You should always seek the advice of a lawyer or other qualified professional for advice regarding your individual situation. While we take care to ensure that the information contained in this video is accurate and up to date, we make no warranties or representations as to the suitability, completeness, or accuracy of the information contained in this video. Any reliance you place on the information is at your own risk. Kahane Law Office, Merrick Law, Heather Malarick Professional Corporation, Evan Clark Professional Corporation, Evan Clark, Heather Malarick, and any guests will not be responsible nor liable in any way for any content, including but not limited to any errors or omissions in the content, or for any loss or damage of any kind incurred as a result of any content communicated in this video, whether by Evan Clark, Heather Malarick, or by a third party. Kim McDonald is a financial advisor with Raymond James Limited. Information provided is not a solicitation, and although obtained from sources considered reliable, is not guaranteed. The view and opinions contained in this media are those of Kim McDonald, not Raymond James Limited. Securities-related products and services are offered through Raymond James Limited, member Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member Canadian Investor Protection Fund. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. Insurance products and services are offered through Raymond James Financial Planning Limited, RJFP, a subsidiary of Raymond James Limited, which is not a member Canadian Investor Protection Fund. When providing life insurance products, financial advisors are acting as insurance representatives of RJFP.
Darkness of the dales dissipates, declines, because of he who turned water into wine.